What's up, y'all? Today I'm going to be breaking down what is the top credit score for you if you're looking to buy a house. I'll also be touching on a few other pieces of information that are going to be vital for you to know about the whole loan or mortgage process in general. So if you're interested in buying a home anytime soon or in the future, then be sure you stay tuned. What's up, y'all? My name is Tomy Boboy, your credit and personal finance coach. And this is your first time on my channel. I'd just like to say welcome. Typically on this channel, I'm talking about things related to credit and personal finance. So if you're interested in improving your credit or achieving financial freedom, be sure you hit the subscribe button down below so you don't miss any of my future videos. Now, despite everything that's going on in the world, there's a lot of people who have started trying to find ways to be able to get a home of their own, right? Even with rising rental prices and things like that, people are starting to look more towards finding a way to actually own the place they live as opposed to just rent it out. Okay. And that's why I thought this would be such a great lesson or such a good video to shoot for today. There's a lot of people who might not know exactly where to start when it comes to getting a mortgage. So I just wanted to touch on a few things, especially from the credit score side of it. That way you have an idea what I think personally when it comes to getting any type of loans. Now, to start off, what is the actual minimum that you would need to even at least qualify for a loan? Okay. Now, it really kind of depends on whatever type of loan that you have, right? If you have or for example, if you're trying to apply for an FHA loan, you're going to be able to get a credit score as low as 580. Okay. Credit score as low as 580 and still be able to do the 3.5% down payment. But if you have a credit score that's lower than 580, I was seeing online that you can even have a credit score as low as 500 might be possible, depending on your situation, as low as 500, but you're more than likely going to end up paying at least 10% down. Okay. So that's kind of what you want to keep in mind for the FHA loan. And now I'll touch on a few other things that you want to know about the FHA loan here in a little bit, but let's jump into the regular conventional loan as well, so you have an idea about that as well. Now, conventional loans, you're typically going to need at least a 620 credit score. At this, you can have down payments as low as 3% down. But it really depends on whatever type of loan you have. Typically, from what I've heard, at least from people that I know personally that have gotten this loan, they're typically saving around 20%. But you can get it as low as 3% from what I was seeing, just depending on different types of loan packages that they have. Now, if your credit score is in a situation where you're definitely not in that range that I just mentioned, right? Your score is even lower than, let's say, for example, a 580, and you're not sure if you're going to qualify. At the end of this video, I'm going to touch on another type of technique that you can use to be able to still qualify for a mortgage if you're in that situation. Now, besides just your credit score, another thing you want to think about that's very important is your down payment, right? Depending on how much you decide to put down, that's going to decide how much of the amount of the home that you are actually going to have to get a loan on or a mortgage, right? And based off of how much you put down into that property, it's going to dictate one other key factor, and that's going to be your mortgage insurance. Now, the idea behind a mortgage insurance is pretty much the exact same thing as any type of insurance, right? It's really to protect some sort of underlying asset. Now, in this case, it's the lender is getting the mortgage insurance to protect them in case of default, right? In case for some reason you're not able to make the payments on the house. Now, the funny part of it is that you are actually the one who pays the mortgage insurance, right? On behalf of the lender. Okay. So the way it works is you will have to pay an additional amount on top of your regular mortgage amount. And this portion is not added to, it's not going to be added into your equity. So it's not like it's helping you pay off the house faster or anything like that. It's solely there just to make sure that if you do default, they at least have some sort of protection. Now, the reason why I bring up mortgage insurance is because there are ways to avoid it. Kind of how I was touching earlier on about the conventional loans. Anytime you're typically, you're paying more than or at least 20% down, or you're putting at least 20% down on a property, you are more than likely going to be able to remove the mortgage insurance. Okay, so that can save you a large amount, especially if you're buying a higher priced home or you're in an area where homes are priced a lot more than normal, right? If you're living in an area like California as opposed to, I don't know, somewhere like the Midwest, right? And so you're able to either if you are, let's say, for example, you are doing real estate where you buy distressed properties or properties that are like a little damaged, right? You buy them for a lower cost and then you improve the property and then you try to refinance it, then you might be in a situation where by you just doing that, you're able to get at least 20% equity. right? And in that case, you wouldn't have to pay mortgage insurance either. And all they really want to see is that you pretty much have put in at least 20% into the home's value. Okay, so whether it's by you fixing up the property and having 20% in equity, or you actually putting 20% as a down payment. Now that's only with conventional loans. If you look at FHA loans, they actually will always have their own type of mortgage insurance. Okay, now unfortunately, there's not really any way for you to be able to get out of that. It's just the way that those loans are set up. Now I kind of made a little example to let you guys understand how much PMI can really affect you, right? Or mortgage insurance, private mortgage insurance can really affect you. Now, to give you a little idea about how much the mortgage insurance typically is, you can assume that you're going to pay about 1% per year, right? In terms of however much of the loan amount that you have. Now, on top of that, depending on what kind of loan you have, you might also have to pay a 1 to 1.5% upfront. And what I mean by upfront is they're actually going to wrap it into your loan. Okay, so on top of, let's say for example, you have $100,000 loan, you might pay an additional $1,000 to $1,500 wrapped into that loan as well. Okay, so typically what I recommend is you do a little research depending on the type of loan that you want to get. Be able to make sure that you do that research and you can see exactly what type of fees and stuff that you're going to end up getting charged for on that. But to give you a little bit of an example, now imagine that you had a $300,000 mortgage. Okay, just on that mortgage and loan, if you were paying that 1% in mortgage insurance, you would end up paying as high as an additional $250 per month. So just think about what you could do with that extra $250. So in some cases, it might make sense for you to just save up a little more before you get a house. That way you can avoid the actual mortgage insurance by you just having a higher amount saved up for a down payment. Okay. And again, guys, that example I gave you doesn't even include, the upfront mortgage insurance that you pay. And keep in mind, guys, this doesn't pay down the mortgage at all, right? You're basically just paying the bank's insurance policy in case that you default. Okay, so now that you have an idea about that, one of the other questions that I see a lot of people ask around online is which mortgage is better, right? Or which loan term is better? Should I go with 15 years or should I go with 30 years? Now, some people like the idea of going with the 30-year mortgage because though you have to pay for a longer period of time, those payments are going to be a lot lower since they're split up amongst double the amount of time. But you also have to worry about paying a higher interest rate. Okay, so it's kind of, there's like a give and take on both sides. Now, me personally, my opinion on it is what you should do is go ahead and sign up for the 30-year loan. So what I would do is sign up for a 30-year loan, but what I'm going to do is I'm going to pay it like it's a 15-year. And what I mean by that is I'm going to make additional payments. So I'll pay whatever my minimum amount is, right, for every month for the loan. But I'm going to put in an additional amount, whatever I'm comfortable or I'm able to do financially. I'm going to put an additional amount in just to pay off the actual mortgage, right? Not to pay off any interest or anything, just to pay off the principal. And by you doing that, you're going to be able to not only pay down your house faster than the 30 years, but you're also going to be able to save on the interest because the interest is spread out amongst those or throughout those 30 years. And you're able to just pay off your mortgage a lot faster and be able to save a little bit towards the end. On top of that, now, when you're looking for loans, make sure that you're shopping at different places. Okay. Typically, what I recommend is you go to wherever your local bank is or your credit union, preferably. They're going to be more than likely wanting to work with you because you guys already have some sort of a banking relationship. So it makes it a lot easier for you, especially if you're in a situation where you're right on the line in terms of what kind of credit score you have and you're not sure if you're going to qualify or not. At those smaller banks, or more specifically at the credit unions, they're going to be able to work with you because you already have that banking relationship and they can kind of see how you are with any other banking products that you use of theirs. Now, finally, what option do you have if you're in a situation where you don't have a good enough credit to be able to qualify for a loan? Now, another option that you can do is something called manual underwriting. Now, I do want you guys to keep in mind, because you're doing manual underwriting, it's going to be a lot longer of a process for you as opposed to whenever you're going to banks and you have the credit score that they can just look at. Now, because they're not able to use your credit score to dictate or make a judgment call in terms of whether you're going to be able to reliably be able to pay off that loan. Now they're going to ask you for additional documentation, right? They're going to want a lot more stuff to be able to get an idea how much you're making in terms of income, right? How much you're bringing in, how much you're spending. That way they can make still an educated decision in terms of whether they should give you that loan or not. Another thing I typically recommend is that if you're in that situation where you're doing the manual underwriting, you're going to want to save up a bigger down payment than normal. Okay. So you're going to want to be a lot closer to saving up a lot closer to that 20%. As opposed to the 3.5%, right? Because it's not gonna be like an FHA loan, especially if you're doing manual underwriting. So be prepared to save up a lot bigger of a down payment. That way you're going to be in a lot better situation. Alrighty, so that's going to be pretty much it for this video, guys. I hope that at least gave you a little bit of a foundation in terms of what to look for whenever you're starting to apply for different mortgages and you're looking to buy a home. If you found this information valuable, be sure that you hit the like button down below and make sure that you hit the subscribe button as well so you don't miss any of my future videos. Anyways, guys, that's going to be it for this video. I'll see you in the next one.